This question tests your knowledge of the IASB conceptual framework definition of an asset. Understanding the exact wording is important because accounting exams often test subtle differences between ownership, legal rights, control, and commitments. According to the conceptual framework, an asset is a present economic resource controlled by the entity as a result of past events. An economic resource is defined as a right that has the potential to produce economic benefits. Key elements to remember. 1. Present economic resource. The resource exists at the reporting date. 2. Controlled by the entity. Control is more important than legal ownership. 3. As a result of past events. A transaction or event has already occurred. 4. Potential to produce economic benefits. Benefits do not need to be certain, only capable of generating value. The word control is critical because many assets are recognized even when legal ownership does not exist. A. Present economic resource, owned by an entity as a result of past events. Incorrect. The conceptual framework uses controlled, not owned. Ownership is too restrictive and does not cover all assets recognized in accounting. B. Present economic resource over which an entity has legal rights. Incorrect. Legal rights may support control, but the framework does not require legal rights in all cases. The key concept is control, not merely legal entitlement. C. Present economic resource controlled by an entity as a result of past events, and from which the economic resource is a right that has the potential to produce economic benefits. Correct. This exactly reflects the IASB definition. Present economic resource, controlled by the entity, resulting from past events. Economic resource equals a right with potential economic benefits. D. Present economic resource to which an entity has a future commitment. Incorrect. A future commitment does not create an asset. In fact, commitments often relate to future obligations rather than existing resources. Correct answer, C. Exam tip. When distinguishing assets from liabilities, remember, asset equals present economic resource controlled by the entity. Liability equals present obligation to transfer an economic resource. In multiple choice questions, control is usually the key word that identifies the correct asset definition. This question tests your understanding of the definition of a liability under accounting standards. A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow of economic benefits, usually cash. When answering this type of question, ask 3 key questions. 1. Is there a present obligation? 2. Did the obligation arise from a past event? 3. Will settlement require an outflow of resources? A liability exists only when all these conditions are satisfied. Future intentions or future business decisions do not create liabilities. A. Dexter's license renewal payment in 12 months' time. Not a liability. Although Dexter may need to pay $50,000 in the future, there is no present obligation. The company can choose not to renew the license. This is merely a possible future transaction, not a liability at the reporting date. B. Reckless investment has fallen from $120,000 to $90,000. Not a liability. This represents a loss in asset value. The investment is still an asset. It has simply suffered an impairment or fair value decline. A reduction in an asset's value does not create a liability. C. Carter's estimated tax charge of $165,000. Correct answer. The company has already earned profits during the year. The tax obligation arises from those past profits and is expected to be paid to the tax authority. Even though the amount is estimated, it is still a present obligation resulting from a past event, meeting the definition of a liability. D. Expansion plans to buy machinery for $570,000. Not a liability. A plan to purchase machinery is a future intention. Unless a binding obligation already exists and recognition criteria are met, no liability is recorded merely because management intends to invest. Correct answer. C. Carter's estimated tax charge of $165,000. Exam tip. Remember the rule. Future plans, not liabilities. Our asset value decreases, losses, not liabilities. Amounts owed because of past events, e.g., tax, wages, loans, liabilities. This question tests your understanding of net realizable value, NRV, in asset valuation. Students often confuse NRV with other asset measurement bases, such as historical cost, depreciated replacement cost, or value in use. The key phrase is net realizable value. In accounting, NRV represents the amount an entity expects to receive from selling an asset after deducting any costs necessary to complete the sale or disposal. Formula: NRV equals estimated selling price, costs of disposal. The age of the asset, 2 years old, is largely a distraction. NRV depends on the asset's current selling value and disposal costs, not on how old the asset is or how much depreciation has been charged. To answer correctly, focus on the definition of NRV rather than depreciation or future cash flows. A. The original cost of the asset less 2 years depreciation. Incorrect. This describes the asset's carrying amount net book value under historical cost accounting. It is not NRV because it is based on past cost and accumulated depreciation rather than the asset's current sale value. B. The amount that could be obtained from selling the asset, less any costs of disposal. Correct. This is the exact definition of net realizable value. It reflects the net amount the business expects to receive from selling the asset after deducting selling or disposal costs. C. The cost of an equivalent new asset, less 2 years depreciation. Incorrect. This resembles a depreciated replacement cost approach. It focuses on replacement value, not the proceeds from disposal. D. The present value of the future cash flows obtainable from continuing to use the asset. Incorrect. This describes value in use, which is based on future cash flows from using the asset rather than selling it. Correct answer. B. The amount that could be obtained from selling the asset, less any costs of disposal. Exam tip. Remember the distinction. NRV equals selling price less disposal costs. Carrying amount equals cost less accumulated depreciation. Replacement cost equals cost of acquiring a similar asset today. Value in use equals present value of future cash flows from using the asset. A common program exam technique is to provide these 4 valuation bases together and test whether you can identify the correct definition.